Welcome to This Explainer. Today, we're decoding the wildly complex and honestly sometimes illusionary reality behind the flashy headlines of Eternal LT. The company you probably still call Zomato. If you've been following this space, you know it's a massively fast-moving, high-stakes game. But the recent data, it reveals a story that is vastly different from what a quick glance at a stock ticker might suggest. We're going to break down their real numbers, dive into the intense quick commerce battlefield, and look at exactly what forces are driving this stock's wild trajectory right now. Let's just get right into it. Here's our roadmap for today. First, meet Eternal beyond food delivery. 2, unpacking the headline numbers. 3, the quick commerce war. 4, leadership and regulatory hurdles. 5, the bull versus bear. And finally, number 6, catalysts to watch. Kicking things off with Section 1, Meet Eternal, Beyond Food Delivery, a New Identity. All right, so we're looking at an absolute behemoth here, a market cap of roughly 2.8 lakh crore rupees, with shares sitting about 20% below their 52-week high. But I want you to look closely at the valuation multiples. The PE ratio, it swings wildly. We're talking anywhere from 110 to 750 times, depending on the day and the source. Crazy, right? Well, why is that? It's simply because their earnings base is still incredibly tiny relative to that massive market value. Notice also that there is zero promoter holding. This is a purely professionally managed institutional growth story where no dividends are paid out. Why? Because every single rupee is being aggressively reinvested right back into the business. You see, Eternal is no longer just a bet on restaurant food delivery. It's actually mutated into this, like, a four-headed hydra. You have the legacy Zomato food delivery that we all know, the cash-hungry quick commerce arm Blinkit, the going out and events business called District, and finally, the B2B restaurant supply chain Hyperpure. So when you buy this stock today, you aren't just buying a food delivery app anymore. Nope. You're buying into a diversified ecosystem that is quite literally fighting battles on multiple fronts simultaneously. Moving on to Section 2, unpacking the headline numbers, illusion versus reality. 168.6%. Just let that sink in for a second. This was the shocking year-over-year revenue jump reported for FY26, bringing their total revenue to a staggering 54,364 crore rupees. On paper, that looks exactly like the kind of hypergrowth that absolutely justifies those massive PE multiples we were just talking about. But let's look a little under the hood, shall we? That massive revenue spike is actually, well, it's a bit of accounting magic. You see, Blinkit fundamentally changed its business model. They shifted from being a simple marketplace taking a commission to an inventory-led model. What this means in plain English is the revenue now reflects the full value of the orders placed rather than just the small cut they take as a middleman. So if you strip away that accounting shift, pure organic like-for-like growth realistically sits somewhere between 60 to 190%, depending on the specific segment, which is actually, scratch that. It's still incredibly impressive, but it's not quite the unbroken 168% explosion that the headline suggests. And right here is the ultimate illusion. If revenue jumped so wildly, why on earth did the full-year net profit actually drop by 30.6% to just 366 crore rupees? The secret is all in the timeline. While the full year looks like a step backward in profitability, the fourth quarter of FY26 tells an entirely different story. In Q4 alone, net profit saw a massive 346% upward spike year over year, and a 70% jump just from the previous quarter. So what does this mean? It means this isn't a declining business. It's a business that just hit a sharp, sudden inflection point late in the year. That brings us to Section 3, the quick commerce war, the battle for minutes. Okay, so for the longest time, quick commerce was basically seen as a bottomless money pit. But recently, Blinkit actually managed to shift from cash-burning adjusted EBITDA losses to eking out a small but positive EBITDA. Honestly, proving they can actually turn a profit while delivering groceries in mere minutes is the single biggest fundamental change for Eternal in the past year. It is the core reason the market is willing to pay such an insane premium for the stock right now. But, and it's a big but, Blinkit is not fighting in a vacuum. They are locked in a fiercely expensive turf war. Swiggy Instamart just raised a jaw-dropping 10,000 crore rupees via qualified institutional placement. Zepto? They've confidentially filed papers for an IPO to arm themselves with even more public market capital. And if that wasn't enough, e-commerce heavyweights like Amazon and Flipkart are now aggressively pushing into the space. To defend its turf, Eternal had to pump 2,600 crore into Blinkit during FY26, and they just topped that up with another 450 crore in 2026. The real danger here? These heavily armed rivals could easily trigger a brutal price war, forcing Blinkit right back into that cash burn pit just to survive and defend their market share. Moving along to Section 4, Leadership and Regulatory Hurdles. Shifting rules and roles. Internally, there is a massive execution risk at play here. In early 2026, founder Deepinder Goyal actually stepped down as MD and CEO, handing the wheel of the broader Eternalship over to Albinder Singh Dinza, who is the CEO of Blinkit. Now, while promoting from within definitely offers a level of continuity, you have to admit that changing the captain of the ship during a period of absolute peak competitive intensity introduces a very real layer of execution risk. Believe me, the market is watching very closely to see if Dinza can maintain that strategic momentum. And externally, well, the environment is getting a bit hostile. First up, the government has issued safety warnings regarding the labor practices and marketing claims around those 10-minute delivery promises. Secondly, a retailer body has filed a formal complaint with the Competition Commission of India, flat out accusing the sector of predatory pricing. Now, impartially speaking, regardless of your personal stance on these issues, these are stark business realities. Either government safety interventions or intense antitrust scrutiny could severely pressure Blinkit's margins or just force them to dial back their high-speed growth tactics altogether. Which brings us to Section 5, the bull versus bear, weighing the evidence. So let's weigh the evidence. The bulls out there argue that Eternal absolutely deserves its premium valuation. They're a multi-category leader, they carry no promoter debt overhang, they enjoy rising mutual fund ownership, and most importantly, Blinkit is finally hitting positive EBITDA. But on the flip side, the bears look at the exact same data and they just see red flags. They see a stock with extreme valuation multiples banking on a short-term quarterly profit trend. They see a hyper-competitive space staring down a 10,000 crore rupee competitive threat, compounded by mounting regulatory targets on their back, all while a brand new CEO is at the helm. All right, final section. Section 6, Catalysts to watch. What's next for Eternal? Right now, technical indicators show Eternal drifting in a pretty choppy, volatile range, roughly flat over the last 6 months, really just waiting for direction. And that direction completely hinges on a few key upcoming dates. You definitely want to keep an eye on Zepto's IPO progress through SEBI because a newly public, well-capitalized rival could trigger some immediate market reactions. But honestly, the most important event on the calendar is July 22nd, 2026. That is the Q1 FY27 earnings call. The entire market is basically holding its collective breath to see if Blinkit's Q4 profitability trend was just a fluke or if it is genuinely actually sustainable. So ultimately, it all boils down to this multi-billion rupee question as Eternal writes its next chapter. Can their operational efficiency actually outrun the astronomical costs of defending their turf in the quick commerce war? It's a massive puzzle, isn't it? Keep these realities in mind the next time you see a flashy headline about this company. Thanks so much for joining me on this explainer today, and we'll see you next time.